So before we begin, I want all of you guys to take some time and think. What are the common perceptions you guys have when it comes to buying stocks? Like, what's the first thing that comes to your mind? So just take like a couple of seconds to think about it. Okay, so a lot of people think that stock investing is only for the rich and the high income earners. Many believe that investing in stocks grows your money but at a very slow rate. These people also say that it's very complicated and hard to understand, so they rather put all their money in those savings accounts that they have. While some are just afraid they might lose all their hard-earned savings. Apparently, also quite a handful believe that buying stocks is a way to get rich quick, so they expect big and fast results. Think of buying stocks as a form of DIY investing. Why? Because you can personally choose what companies you want to invest on, and a good thing about this is that you can sell them as and when you like, giving you the money just in case you need them. So buying stocks is not just for the rich, it's literally for anyone with a rich mindset that wants to grow their money. It's not that expensive either. Let's say you want to invest in Singapore blue chip companies. A lot of good ones cost you about $2 to $3 a share. Since the minimum lot size in Singapore is 100 shares, right? The investment will only cost you about $200 to $300. So for those who think that stock market investing is very complicated, I want to show you guys that it's actually quite easy to understand, and by the end of this webinar, you guys will be able to buy stocks the right and easy way. Just to make it clear, if you were to do your own due diligence and all the proper homework and analysis, it will be nearly impossible for you to lose all your money. And to those people who are expecting to get rich quick, it's still possible for you guys lah. Only if you use the growth strategy and pick the right stocks. So for stocks, right, think of it as a kind of investment that signifies the ownership of a company. When you buy stocks, you guys will actually become owners, as you get to own a small part of it. And for these companies, right, issuing stocks is actually a good thing for them. You might be thinking, why do these companies want to share their business with outsiders? I mean, by issuing stocks, they are only giving out a portion of their company, and the money they receive can be used to grow their business even further. So why do people buy stocks? Come on man, this is a no-brainer. You buy stocks so that you can earn more money, right? By buying stocks, we are actually helping the company to grow, and when they grow, our money grows as well. When people buy stocks, they talk about capital gains and dividend gains. Capital gains is when the prices of your stocks go up, giving you a profit. Whereas dividend gains is the interest you receive for investing in the company. It's kind of a way to thank the investors. And when companies want to issue shares to the public for the very first time, right, they have to go through this process called IPO, Initial Public Offering. By doing this, they are hoping to raise capital from the masses so that they can improve their business even further. And that's how people like you and me are able to buy stocks too. Yeah, this is a very tricky question to a lot of new investors, but don't worry, it's actually quite simpler. In simple terms, stock market is a place where stocks are traded. Think of it as a supermarket, where stock exchange is more specific to where the trading is taking place. In Singapore, we have SGX, or in overseas countries in the US, we have Nasdaq and NYSE. So stock exchange is like the individual sections of a supermarket. If you want to get chicken, you go to the meat section. If you want to get fish, then you go to the seafood section. Something like that. Okay, it's time to get you guys started. Whenever someone wants to buy or sell a stock, they have to go through a broker first. The broker acts as a middleman that connects the buyers and sellers together. But before we even choose a broker to begin with, we have to decide on the type of account we're going to use. best to find one that suits us the most. The three main accounts are CDP, Custodian, and CFD. So firstly, we have the CDP where stocks are purchased under your name and stored under the Central Depository account. Since it's purchased under your name, you are a legal shareholder and can attend actual meetings hosted by the company, also known as AGMs. So with this CDP account comes higher brokerage fees, but it also acts as a safe haven for all your stocks. In the event where a broker goes bankrupt, your stocks will still be safe and sound under your CDP account as it's a separate entity. Since all your stocks are stored under one CDP account, you are able to buy stocks from one broker and sell them from another. For example, if I want to use DBS Vickers to buy and use Maybank to sell, it's perfectly fine as well. Moving on to Custodian, stocks are not purchased under your name and it's held under the custody of a broker. Means that if a broker ever goes bankrupt, you might also lose all your stocks as well. However, if you change your mind, the good thing about Custodian is that you are able to switch to CDP anytime you want. Just pay a small fee can already. Lastly, for CFD, you don't own a stock at all. You are merely speculating the difference in price. For example, if you were to open a position at $10 and it goes up to $12, you profit at $2. But if it drops to $7, you lose at $3. It's quite similar to buying and selling a stock, just that we don't own it. Most of the CFD accounts I know barely charge any fees. But if the CFD broker goes bankrupt, all your money will be gone together with the firm. The good thing about CFDs is that it offers short selling and leverage feature. Both are very powerful tools to earn money, but it also can be a double-edged sword. Okay, so for brokerage firms, there's really too many out there, so you really have to do your own homework and research and find out what's best for you. However, here's some tips I can give you. When looking for a broker, find one that's trustable, one with the lowest fees, and also one that is the easiest to use for you. After you have chosen your broker and trading accounts, you guys are going to start buying and selling stocks. So how do we make a trade? Very simple. We buy at the ask price and we sell at the bid price. But before we even buy or sell a stock, we have to place an order first. There are three main types of order. Firstly, market order, then limit order, then lastly, stop order. For market order, we are buying or selling at a market price, which is also the current price, and our orders usually take place immediately. Okay, then let's say you want to buy a stock, but you think you can buy it at a lower price. Or like you want to sell a stock, but you think it will go up even higher later. You can always set a limit order. By setting a limit order, right, you will be able to buy or sell the stocks you want when it reaches the price you want. However, there's a risk that it may never reach the price and you will never get the stock you want. Lastly, for stop order, it's more for stopping losses. By setting a stop order, your broker will sell the stock for you when it reaches below a certain level, preventing you from further losses. Now that I've gotten you guys started, it's time to make some money. So in the stock market, there are three ways to make money: going long, going short, and being flat. If you think that the price will go even further, then take a long position. What it means is that you buy the stock now, hoping to sell it at a higher price later on. Then what if you think that the stock price will drop? Or what if the stock price is already dropping? Don't worry. You still can go short and make money out of this also. By going short, we are actually borrowing stocks we do not own from our broker to sell it now, hoping for the price to drop later, so that we can buy at a lower price and return it to them. If there isn't any good opportunity, or if the time isn't right, or let's say you haven't done your homework yet, then there's absolutely nothing wrong with being flat at all. Why? Because the money you spend now could have been used to make you more money when a good opportunity comes by. Always remember this: the stock market is a device for transferring money from the impatient to the patient. One of my favorite quotes from Warren Buffett. Yes, it's finally time for you guys to pick some stocks. So whenever we pick stocks, we want to do our homework first. It shouldn't be the case whereby you decide to buy a stock just because your friends or people on the internet tell you so. There are two ways you can do our homework. The first way will be fundamental analysis, that's called FA for short, and the other will be technical analysis, TA for short. So when do you use them? It all comes down to your time horizon, really. If you plan to buy stocks for the short term, then technical analysis might be better for you. But if you plan and hold for the long run, then fundamental analysis might be better for you instead. So let's use buying a house as an example. Imagine walking into those condo show flats to buy a 3-bedder unit. If you plan to sell the house 10 to 20 years later, then fundamental analysis might be more useful for us. As such, we are going to pay more attention to the infrastructure of the condo, whether the development is good or not, or if there's any upcoming construction plans in the neighborhood. However, if we buy only the intention to sell the next year after the place has DOP, then technical analysis might be more useful for us. So instead, we are going to look at the prices of resale houses nearby, and also the number of people buying and selling them. So which one is better? Some people swear by using fundamentals only, while many of the day traders and swing traders use only technicals. I mean, both analyses are good in their respective ways, but if you want to gain an edge over others, you really have to use both. Once you use both, you'll be more inclined to make better decisions, thus maximizing your returns. When we do FA, we want to understand more about the company, get to know the real and intrinsic value, more of what it's really worth. So we want to look at things like the business model, ratios, and statements. First things first, you have to ask yourself, what's so good about the company, right? And in order to do so, we have to find out about the business model first. So what is a business model? Basically, it consists of their sources of revenue, where they get the money from, the customer base, products and services they offer, as well as the reason for buying them. By understanding the business model, we are able to get a bigger picture of what the company is doing and whether it will do well in the near, mid to long future. Another thing we should take note of would be their management. So by studying the management, we know how the company runs its business together with the goals and plans they have. If you were to ask me, this is the most crucial and important part of FA. Think about it. Once you understand the business model and how the management works, a fall in stock prices won't really affect us much, right? You know why? Because we are confident that the company will do better in the longer run. Besides the business model, we want to read out on the company's financial statements and ratios as well. So what are they? Financial statements consist of 3 things: income statement, balance sheet, as well as cash flow statement. It's very good for investors as you can see how the company is performing over time when you compare the year-on-year results. For those that don't understand what the statements are or think that this is info overload, don't worry. The ratios are still here for you. Basically, financial ratios are simplified versions of the statements, and they allow retail investors like us to evaluate the stocks you want easily. There are plenty of ratios out there, so to make it easy, we are going to group them into 4 main categories: profitability, valuation, liquidity and debts, as well as efficiency. I have consolidated all the common ratios into the various categories, so be sure to check them out after this webinar, or as and when you need it, it's fine as well. Oh yeah, these ratios may vary from industry to industry, so please be sure to only compare ratios for companies within the same ones. Moving on, the other way we can do our homework would be to use technical analysis. When we do TA, we are forecasting the direction of stock prices by studying past trends. So when we study past trends, there are 2 things we want to look at: past prices and volume. The trend is your friend. I'm sure you guys have probably heard that before. Basically, what it means is that since past trends are bound to happen again, why not just study them, right? But how do we study past trends to begin with? Very simple. We look at the charts. Most retail investors like your father, mother, auntie, uncle all like to use line charts. I mean, it's the easiest to read, so why not, right? Then when we ask these retail investors to study or do more TA, most of them will be like, wow, so cheap, so many technicals, don't wanna. I also not a professional trader, I learn for what? I wanna show you guys that technical analysis ain't that hard. And besides line charts, I want all of you guys to learn how to read candlestick charts as well. Once you study candlestick charts, you will be able to do TA like a pro, man. Trust me. So if you want to learn how to study these charts under 5 minutes, go ahead and check out this post after the webinar. I really urge all of you guys to learn this, as it gives you a fuller view of what is happening to the stock. Besides candlestick charts, I want all of you guys to know what is support and resistance. If you think that these technical terms don't affect you, then you are wrong, because it gives you a better idea of when to buy and sell the stock you want. So think of support levels as something that prevents stock prices from dropping further. These levels are actually considered good buying opportunities for the investors out there. So as you can see, $10 is a good buying opportunity, as whenever it reaches close to $10, people start to buy and push the price back up again. Similar for resistance level, it's more of a barrier that prevents stock prices from rising further. These levels are actually considered good selling opportunities for investors out there. So looking at the charts, $20 is a good selling opportunity, as whenever it reaches close to $20, people start to sell to push the price back down. I want you guys to notice how the support and resistance level are done up just by studying past trends. As you can see, $10 has been a good buying opportunity for investors in the past, so it also became a good buying opportunity for investors now. So by studying these trends, we will know better when to buy and sell the stock we want. I get a lot of people asking me like, hey, what's the difference between trading and investing? Both also buy and sell stocks, what? Why you have two different names? To clarify our doubts, here's why. Trading is more of short term, while investing is more for the longer term. When people trade, they do intraday trades, which means buying and selling stocks within the same day, or they do swings, also known as buying and selling them a few days later. As mentioned in the previous slide, since the time horizon they have is short, technical analysis would be more important to them. Whereas for investing, the time horizon is longer, so fundamental analysis would be more important. I'm not trying to say you should use only TA when you trade and FA when you invest. In fact, you have to use both, be it if you are trading or investing. It's just that one is more important than the other, that's all. Now that you guys know most of the basics, I'm sure you want to know what's the best time to invest also, right? Sorry, but the truth is, there isn't. I mean, you can try to time the markets but it takes lots of practice, and you'll never be right all the time also. You know how volatile and irrational the stock market is not? One day can down 10%, next day can up 30%. Even hedge fund managers and experienced traders can't get it right 100% of the time also. Don't try to time the market. Spend time in the market instead. The best way to do so would be to use dollar averaging cost method, DAC. So when you practice dollar averaging cost, you invest a fixed dollar amount over regular time intervals. Give you an example. Instead of investing your hard-earned savings of $10,000 at one go, you invest $1,000 over a period of 10 months. Here's what's so good about it. After you've done your homework, all you have to do is just pump money in every month. Really hassle-free and good for hardworking people who's either busy with school or work. Another thing is that you will be able to buy more shares when the price drops, and lesser when prices go up. Means there's a high chance you get to lower the cost price of your stocks over time. Don't say I need help. I'm going to recommend some useful sites and platforms so that you guys can get your homework done easier. at least you guys can start somewhere, right? So firstly for FA, I want all of you guys to check out Yahoo Finance. It's like a one-stop page for all your homework, man. Literally has everything you need to know on the stock you want. From the profile of the company to the ratios and statements, it even provides news as well. Let's say it's not enough, right? You still have your brokerage apps and company websites to help you also. Whereas for your TA, you can try using TradingView because it's very simple and easy to use. You can easily draw lines to mark your support and resistance level, and you can also write down notes as well. For those who are more into TA, there are lots of other functions and indicators for you to play around with, so just check it out lah. Now we have come to the question that all you guys are waiting for. I want to grow my money, but should I try stocks or Forex? It's really up to you. Based on your personal preference and interests, choose what you want. If you are interested in understanding companies, then you can go for stocks. Whereas if you want to understand currencies, then go for Forex. Forex traders only have a few currency pairs to watch, as those are the ones that make their money. Whereas for stocks, right, there are thousands and thousands of stocks with endless opportunities out there. In my opinion, if you want to speculate and trade short term, then Forex might be better for you. I mean, the Forex market has much more volume, and it's also more volatile than stocks in general. Together with a 24 hours market, traders can really use it to their advantage to achieve the short term profits they want. I'm not saying that you can't trade short term with stocks. You still can. It's just that the Forex market is more favorable for you. If your time horizon is longer and you want a more passive style, then stocks might be better for you instead. You see, it really depends on all the needs and goals you have. I'm not going to convince you guys on why you should start investing today. I know a lot of people will tell things like, oh, you need to invest because you can beat inflation, blah blah blah, that crap. The reason why you guys are even attending this webinar is because you probably have a rich mindset and you're willing to learn. So I believe most of you already know the importance of investing. I hope through this webinar you guys have learned how to invest the right way. And if you are keen to know more about stock market investing, you can always check out our One Stock Instagram page. Maximize your returns with better investment decisions today. This is the value I aim to provide guys with, be it through webinars, Instagram posts, as well as future products and services we will offer. There will be another webinar coming out soon, maybe 1 or 2 months time from now. We'll probably touch on more advanced things like timing the market smartly and also strategies you can use. For new investors, don't worry. You can use this time to work on yourself first and master the basics. And for those who have any queries, you can always head down to our Instagram page. There'll be a Q&A post on our IG story once in a while. I know some of you guys might need time to think of your questions, and I want to answer everyone as accurately as possible. So I think this is the best choice lah. I really hope that you guys found this video useful, and if you have any like-minded friend who's keen and want to learn how to buy stocks the right and easy way, do share this video with them, okay? Thanks for watching guys.